Welcome to Alpha Recap. Today we're breaking down the big market moves after the close. Earnings, AI Capex, and a chip schism. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks for having me. Lots to unpack from today's tape. Some very strong data points and some real contradictions inside technology.
Let's jump right in. The headline that grabbed everyone was a record June from Taiwan Semiconductor Manufacturing Company, TSMC. And we have to call out that number. So, the company reported revenue that jumped about 67% to about $13.2 billion. That was a huge print.
Yeah, that print was front and center. TSMC is effectively a bellwether for global foundry demand. When a foundry that size posts a year-over-year jump like that, it usually signals heavy orders from hyperscalers and enterprises building out AI and cloud infrastructure.
And the market reaction was interesting. Shares only moved modestly, around about $40 on the quote we saw. I mean, when you step back and look at this, why wouldn't investors just cheer loudly?
Not always that simple. Foundry growth cascades into tool makers, substrate suppliers, and upstream vendors. But not all suppliers benefit equally. It depends on node mix, leading edge versus mature, and capacity cadence. So the headline was very strong, but the gains are uneven across the supply chain.
Right. And adding to that, Bank of America put out a note saying that advanced micro devices, AMD, could beat and raise because of exceptional server demand. So we have multiple data points pointing to enterprise strength.
Exactly. Server and data center demand was the consistent thread. AMD's setup was framed as strong because servers were restocking for AI workloads. Analysts note that the enterprise and hyperscaler pull is supporting both chips and foundry orders.
But at the same time, CNBC's Jim Cramer flagged a chip stock sell-off. So we had this split. Record foundry revenue on one hand and sector weakness on the other.
Yeah, that tracks. What we saw was dispersion. Some leading-edge manufacturers looked very robust, while certain equipment names or consumer-facing chip firms lagged. That kind of intra-sector divergence often comes down to positioning, valuations, and near-term demand differences.
So to boil that down for listeners, strong end-market demand for data center and server chips, but market positioning and valuation sensitivity produced volatility and a sell-off in parts of the sector. Short reaction, big move. Let's shift to another giant headline. Meta announced it was increasing AI data center spending to more than $50 billion. That is a multi-year commitment with big implications.
That figure is massive. Capital intensity at that scale reshapes demand for data center construction, server OEMs, and specific semiconductor nodes. But there are trade-offs. Heavy Capex pressures near-term free cash flow and raises questions about the timing of monetization.
Right, and I want to highlight that classic capital allocation trade-off. You build an AI moat, but you also take on execution and cash flow risk. Honestly, I was a bit surprised by this one.
Same. It signals conviction in AI strategy, but it also means we should watch margin flow-through and how soon the infrastructure translates into revenue growth.
Turning to earnings expectations. Wall Street consensus for the S&P 500 was roughly 22% year-over-year earnings growth for the quarter, down from the stronger print earlier in the year, but still elevated. Evercore ISI also weighed in, saying profit growth could blunt AI-driven rotation.
That higher bar matters. When consensus is elevated like that, you get more dispersion and bigger reactions to beats and misses. Analysts note that option positioning can amplify moves, which we saw in options flow ahead of Netflix's report.
Let's talk Netflix briefly. Options flow showed a bullish tilt into earnings. Calls were dominant, and some of the skew metrics were roughly 13% on one measure and around 6% on another. Concentrated positioning can really turbocharge the stock's move after the print.
Right. If a lot of traders are long calls and the stock beats, the rally can be faster because some positions get forced to cover. Conversely, a miss can be magnified to the downside. For event-driven players, that creates opportunity, but also risk.
Short reaction, not what anyone expected.
Yeah, absolutely.
Another institutional note, Longleaf Partners emphasized value and income names in their quarterly letter. They called out names like FedEx and MGM on valuation metrics. At the same time, Zacks and others highlighted momentum contributors like Micron and United Health.
This is the classic value versus momentum debate. Longleaf is focused on price to value and price to free cash flow metrics, which tends to favor beaten down, cash-generative names. Momentum players are chasing AI and growth narratives. Both camps have data to support their views, and earnings will probably tip the balance short-term.
And then there were some idiosyncratic stories. Regeneron had a trial disappointment, and that reminded everyone about event risk in biotech. JP Morgan had headlines around leadership scrutiny, which is reputational more than cash impacting, but it can matter to multiples.
Reputational and regulatory headlines can change client behavior and increase scrutiny. Even if there's no immediate cash effect, multiples and sentiment can be affected. So it's worth monitoring, especially in large banks.
Quick reactions, big headlines, concentrated flows, and nuanced policy risk.
Right, and speaking of policy, Fed Governor Christopher Waller warned that policy shouldn't fight the last war and kept the door open for more hikes if inflation doesn't fall toward thresholds like 2.5%. That kept the possibility of higher for longer rates on the table.
Which, raises duration risk. Higher for longer rates make equities more sensitive to earnings shocks and multiple compression.
Exactly. Elevated earnings expectations increase sensitivity. If inflation broadens and the Fed tightens again, you could see swift multiple repricing.
Let's walk through practical implications for different investor types. Active traders and event-driven players, your world was busy today.
They saw elevated intraday volatility. Options flows and concentrated positioning mean outsized moves around earnings. Those players need to manage position size and be ready for rapid repricing.
Growth and AI investors?
Meta's large Capex and strong server demand support the AI narrative, but analysts note you should watch Capex intensity, margin flow-through, and the time it takes to monetize the investments.
Value and income investors?
Longleaf's note suggested there are select, beaten-down names with attractive cash flow metrics. That can look compelling if you believe profit trends hold and rotation continues.
Biotech and small-cap speculators?
Event risk remains acute. Clinical updates can move names dramatically. Regeneron's miss and the Alzheimer's buzz around another name show how quickly sentiment can shift in that space.
Macro and asset allocators?
Waller's comments mean you can't dismiss the possibility of more tightening. That keeps the equity risk premium sensitive to macro surprises and inflation data.
Some strategic considerations to leave listeners with. Reassess scenario plans for earnings season. Differentiate within sectors, especially semiconductors. Monitor Capex-linked supply chains, and keep an eye on reputational and regulatory headlines in financials.
And maintain liquidity and consider hedging or position size discipline into concentrated events. Options positioning can inflate moves, and that's not just theoretical. We saw it in practice today.
Final takeaways. 1. The tape underscored a market of coexistence. Strong fundamental data points like TSMC's record June and server chip demand, alongside narrative-driven rotation and intra-sector divergence. 2. Elevated consensus earnings growth, roughly 22%, raises the bar and increases the potential for outsized reactions to beats or misses. 3. Heavy AI-related Capex, led by Meta's more than $50 billion plan, will reshape supply chains but also press near-term cash flow and execution risk.
To add, analysts note that policy uncertainty remains a wild card. If inflation doesn't come down toward target-like thresholds, the Fed may act, and that adds a two-way risk to equities.
Quick 3-word reactions.
Complex, but actionable.
All right, that wraps our recap. This discussion was for informational purposes only and does not constitute personalized investment advice. Analysts note market views can change as new data emerges.
Thanks for listening. If you have follow-ups, we'll try to answer them.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. See you next time.